Today, we will be presenting a U.S. market analysis dated March 30th, 2026.
Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
This video presents a direct informational narration of the source document. So here's our roadmap. We'll kick things off with market performance and macro sentiment. Then we'll dive into geopolitical dynamics and energy, followed by a look at monetary policy and the bond market. After that, we'll zero in on memory stocks and semiconductor risk, analyze the mega-cap tech players, and finally, wrap everything up with institutional positioning and the overall outlook. Okay, before we get into the details, we have to go over the standard risk disclosure. Please remember, this is all for informational and research purposes only. It is absolutely not investment advice. Investing in financial markets carries significant risk, and any decision you make should be your own. Also, keep in mind that the information here is, of course, time-sensitive and can change. All right, let's get right into our first section, market performance and macro sentiment. This is really all about framing the current investor psychology. So taking a look at the numbers, you can see widespread weakness. The Nasdaq was down 0.78%, showing tech shares are still under pressure. But wow, look at the Russell 2000, down 1.44%. It was the worst performer, and that really reflects the damage being done to small caps in financials. The S&P 500 barely clunked a key support around that 6,300 level. But honestly, the biggest story here is crude oil. It broke above $100 a barrel, and that is a massive signal that's shifting inflation expectations. And this brings us to a really crucial macro insight. This sell-off we're seeing, it's not just blind panic. The source sees it as a rational, logical de-risking. It's a direct response to those runaway energy costs and inflation expectations that are becoming unanchored. This whole situation suggests that the market has entered what the analysis calls a high-volatility, low-forgiveness regime. Basically, a market where any piece of bad news can set off a major wave of selling. That pressure from energy prices is the perfect segue into our second section, geopolitical dynamics and energy. And here we'll get into something the source calls the hedgehog game playing out in the Middle East. So what's happening on the ground? Well, right now, all eyes are on the Middle East. The analysis points to two critical facts. First, the Houthis entering the conflict and the direct strike on the Haifa refinery. That means this confrontation is now directly hitting core energy infrastructure. Second, you have all this heated rhetoric surrounding Iran and the Strait of Hormuz, which has forced the market to price in a much higher tail risk premium. And this is where that hedgehog game analogy comes in. It's a pretty brilliant way to think about the stalemate. The US and Iran are like two hedgehogs who want to get close for warmth, but can't because neither one is willing to be the first to retract its quills. It's this dynamic that makes it so difficult for that energy risk premium to just fade away. As long as the strait remains a major point of tension, the analysis suggests oil prices are going to have a very firm floor underneath them. So, with all of this geopolitical risk swirling around, you have to wonder, how is the Federal Reserve responding? Well, that brings us right to Section 3, where we'll look at monetary policy, Chairman Powell's soft reassurance, and the critical warning lines in the bond market. Now, in the face of some weak Treasury auctions, Powell has tried to sound a bit more conciliatory. The source even likens his change in tone to swapping hard liquor for milk tea. But the bond market isn't so easily swayed. It has some very clear lines in the sand. For the 10-year Treasury yield, the safe zone is back below 4%. The real danger zone, though, is that 4.5 to 4.65% range. If that level gets breached, you could see yields shoot towards 5%. And that could trigger a whole other wave of selling in the stock market. And Powell might be trying to downplay the risks, but then you have JP Morgan referencing the cockroach theory. That's pretty telling. It's the idea that for every one problem you see in the credit markets, there are probably many more hiding in the shadows. This deep concern about credit quality is the real reason we're seeing short positions against the Russell 2000 climb to a record high. The market is bracing for more bad news. Speaking of risk, let's zoom in on a specific sector that's showing some pretty serious signs of trouble. In Section 4, we're going to examine memory stocks and semiconductor risk, where the source is identifying a potential distribution phase. Memory stocks are often seen as the canary in the coal mine for the entire semiconductor industry. And right now, that canary is flashing some major warning signs. Just take a look at Micron. It sold off another 9.88% on heavy volume, down to $321. The daily chart printing what's known as a bearish Marubozu candle. And for those who don't follow technicals, that pattern basically screams that there is a complete absence of institutional buying support. A strategist cited in the source offers a really powerful analogy for this. They say it's a classic distribution signal. Think of it like this. Retail investors are moving into newly completed high-priced apartments, while overseas institutions, acting as the developers, are cashing out. That kind of divergence between retail and institutional money is often a huge red flag that an industry's cyclical peak could be very near. Okay, so if smaller companies and the whole semiconductor space are in trouble, where is the money supposed to go? That question leads us straight to the mega-cap tech stocks, which are often seen as the market's final safe haven, its last line of defense. Let's see how they're actually holding up. Well, when we look at the biggest names in tech, the picture is fractured, to say the least. Meta is showing some strength, holding above that $520 support level. But Nvidia has broken below its key 167 support area, which has shifted its technical setup to bearish. Meanwhile, you have Tesla and Microsoft, which are both kind of directionless. Tesla's just trading in a wide range, and Microsoft is below 375, but isn't showing any clear signs of stabilizing. This is not the unified leadership you want to see. And that's really the key takeaway here. The generals are not leading the charge. This leadership divergence isn't just failing to support the index. What's worse, the analysis warns that these names could actually become an anchor, and they could drag the market's entire bottoming baseline lower if they start to fall too. So let's put all of these pieces together. What is the bottom line? Our final section gets into the institutional outlook and lays out a framework for where the market might finally find a floor. The analysis really boils it down to two clear scenarios, and everything hinges on what happens with the Strait of Hormuz. In the optimistic scenario, if the strait reopens before the end of April, the reference bottom for the S&P 500 is around 6,100. But in the pessimistic scenario, if that closure persists, that target shifts down pretty significantly, toward 5,500. So what's the investment conclusion from the source? Well, it's very direct. It says the market is in an extreme bear suppression phase. The advice is for investors to stay strategically disciplined and to maintain a high allocation to cash. And until a forceful, high-volume reversal pattern actually emerges, it would be unwise to try and blindly place bottom fishing orders. And as we close, just a final professional disclosure. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, or trading advice. The author is not acting as a registered investment advisor. Investing and trading in financial markets involves substantial risk. Any investment decision is undertaken solely at the reader's own discretion and risk. And as always, past performance is not indicative of future results.